When we're talking about bonds, we are required to really talk about interest rates. The coupon rate and the yield of the bond both reflect current interest rates in the market. The coupon rate reflects the interest which the market is demanding at the time that the bond was planned. So there is a difference between what the coupon rate represents and what the yield of the bond is going to represent. The coupon rate is fixed. It's going to stay the same regardless, and that's going to determine what the dollar figure is that the borrowing company is going to have to pay out to investors over time. Whereas the yield is going to go up and down based on what the market price of the bond is, how much demand there is for that bond. Since risk determines the rate of return which investors will bear, we also need to consider how risk relates to these interest rates. So what risks do bondholders face? There are two risks that we need to focus on. One, of course, is the possibility of callability. And we've talked about computing the yield to call to determine what would be the return in that instance. But the other is the risk of default. What happens if a company does not pay back their debt? What's going to happen in this case is the bondholder is never going to receive the face value, and they'll more than likely receive fewer interest payments than what they had contracted. So the more likely that seems, the lower the price on that bond is going to be. And the less likely it is, the higher the price on that bond is going to be. As the price goes up, the yield, or the interest rate required for that debt, is going to go down, and the opposite is true. If the price is going down, then the yield is going to rise. In other words, the yield reflects the interest which the market requires right now, based on the risk faced by the holders of the bond. When we're talking about the capital of a company, we need to think about how a firm is financing its assets. All of a company's assets are backed by either equity or debt. Think about the basic accounting equation for a moment. Assets equals liabilities plus shareholders' equity. Assets that were backed by liabilities, in other words, assets that were backed by debt, mean that the cost of that debt is going to be the yield demanded by lenders, by bondholders. Whereas the return required on equity is going to be the rate of return demanded by either holders of common stock or holders of preferred stock. Our equity is going to come in a couple of different types, and we're going to talk about common stock and preferred stock when we're discussing this. Each type of capital is going to bear a different amount of risk. Debt has the most structured arrangement. The contract has a specific set of circumstances which must be followed, and interest gets paid out before any dividends are computed or made available to shareholders. So because of that structure, debt has the least risk and will have the least cost, or the smallest percent return that's required by the lenders. Common stock has the least structured arrangement. There are no guarantees when you buy stock that the price will go up or down. There is no guarantee that the company will or will not pay out a dividend. Common stock has the most uncertainty and therefore the most risk, and will make investors require the highest rate of return. So if we're looking at the relationship between the rate of return required by these different parties, our rate of return for debt, or our cost of debt, KD, is going to be less than the cost of preferred stock, the interest rate or rate of return required by investors in preferred equity, which is going to be less than the rate of return required by common equity holders. So looking at that relationship on the second to the last line, you can see that KD as a percent is always going to be less than KPFD, which is always going to be less than KE. When we're talking about these different costs, what we're really talking about is the capital structure of the company. We're talking about the mixture of capital used to back the assets in the company. Total capital would be equal to the total assets in the company, and the amount of debt plus the amount of equity is going to add up to the total assets. So the percent that each one of these takes up would make up our mixture of capital. Again, we'll call that capital structure.